All right, let's talk about NXP Semiconductors. They just dropped their earnings, and on the surface, things look pretty good. They even gave some pretty upbeat guidance. So why did the stock tank? That's the big question we're going to dig into right now. What did the market see that maybe the rest of us missed?
And there it is, down almost 4% on a day with what should have been good news. It's a real head-scratcher, right? This is the kind of thing that makes you go, So to figure this out, we've got to peel back the onion and look past the big, flashy headlines. Let's get into the nitty-gritty of the numbers and what was said on the earnings call.
Okay, first things first, the print. Let's take a look at the actual Q3 results. This is what everyone was reacting to. So when you first glance at this, it looks fine, right? Non-GAAP EPS, right in line with expectations. Revenue, a little bit of a beat. Solid. But here's where the plot thickens. This is our first clue. Look at the growth numbers. Yeah, revenue was up a healthy 8% from last quarter. That's good, but it was still down 2% from this time last year. That's not so good. See, it's not a clear home run. It's a mixed bag. And the market absolutely hates mixed signals. Now, let's slice up that revenue pie. No surprise here, Automotive is the big kahuna, the main engine driving this company. But check this out, the real star of the show this quarter was mobile. I mean, a 30% jump from Q2, wow, that's huge, and it's all thanks to some new products hitting the market. And even the other big segments, auto and industrial, they were chugging along with some nice growth too. So far, so good. And let's not forget, NXP is an absolute cash machine. I mean, look at these margins. Gross margin at 57%, operating margin near 34%. That's really solid. They cranked out over $500 million in free cash flow. And here's the key takeaway for investors. They're not just sitting on that cash. They're giving a huge chunk of it, over 60%, right back to shareholders through buybacks and dividends. You love to see it. All right, so the Q3 numbers were decent, maybe a little mixed, but decent. But you know how Wall Street is. It's always about, what have you done for me lately? Or more accurately, what are you going to do for me next? So let's look at the guidance. This is where management really tried to sell their story. And boom, here's the bull case in a nutshell. Look at that bar. They didn't just meet the street's expectations for Q4. They blew past them. They guided to a midpoint of $3.3 billion, which is way above what analysts were expecting. I mean, on paper, that's a huge vote of confidence from the C-suite. And they didn't just drop the numbers, they gave us a narrative to go with it. Now, you've got to remember, this was the very first earnings call for the new CEO, Rafael Sotomayor. Talk about a debut. And he came out swinging, talking about continued strength and a steady cyclical recovery. The message was crystal clear. Hey everyone, the worst is over. We've hit the bottom, and we're on our way back up. Okay, so that's the short-term picture. But management also wanted to talk about the long game. The big strategic chess moves they're making. This is all about trimming the fat and doubling down on what's really going to drive growth in the future. Yeah, it's a classic corporate makeover. They're selling off their MEMS sensor business, the little motion sensors and all sorts of gadgets, to STMicro. That frees up a nice chunk of change. And what are they doing with it? They're going shopping. They're buying up smaller, smarter companies to get even better at in-vehicle networking and edge AI. They're adding things like programmable NPUs, that's neural processing units, basically the brains for AI right on the device. Smart moves. Okay, let's hit pause and recap. We've got a decent quarter, surprisingly strong guidance, and a smart-looking long-term strategy. Everything seems to be pointing up, right? Which brings us right back to our big mystery. Why on earth did the stock get hammered? And this right here, this lays it all out. On one side, you have management painting this pretty picture of a recovery. On the other side, you have the market's verdict, a big red number. It's like they were listening to two completely different earnings calls. So you just know investors were digging into the fine print and found something they didn't like. So let's play detective. What did the market see? What were those little breadcrumbs of caution that were buried under all the optimistic talk? It's time to build the bear case. And I think this is it. This is the smoking gun. In the middle of the call, the CEO dropped this little bombshell. He said, and I'm quoting here, "We do not yet anticipate direct customer inventory restocking." Whoa, okay, that is a massive caveat. For a real, roaring recovery to happen, you need customers to start buying extra chips to build their inventory back up. NXP is basically telling us, yeah, that's not happening yet. And that just throws a whole lot of cold water on the recovery story.
Okay, reason number 2 the market got spooked? Those nagging year-over-year numbers. Remember that negative 2% overall? Well, if you look deeper, the communications infrastructure business was down a whopping 27%. That part of their business is like a canary in the coal mine for the global economy. So when it's down that much, yikes. Plus, margins were down a bit year-over-year too. The market looked at all that and said, yeah, this recovery feels shaky.
And the final piece of the puzzle is a bit technical, but it's super important. It's called channel inventory. Basically, it's how much of NXP's stuff is sitting on the shelves of their distributors waiting to be sold. Now, their ideal number is 11 weeks worth of product, but right now, they're only holding about 9 to 10 weeks. What does that tell you? It tells you NXP itself is being cautious. They aren't confident enough to send a ton of product out there. It's another sign that they don't fully believe in a big, strong recovery just yet.
Okay, so let's put it all together. You've got the good news, the guidance beat. You've got the bad news, the year-over-year weakness, and you've got the cautious subtext about inventory. So what's our take? What's the call here? Let's wrap this up with our analysis. All right, after crunching the numbers and reading the tea leaves, we're calling this a market perform. Look, this isn't a sell everything kind of situation, but all that cautious language we just talked about, it really makes us think the stock might just trade sideways for a bit. The upside feels limited in the short term.
So here's our thesis, broken down. The positives? Hey, a recovery is starting and their long-term strategy makes a ton of sense. We like that. The neutrals? That guidance beat was nice, but the comments about restocking really put a lid on the excitement. And the negatives? Those year-over-year declines are still ugly and there could be some pressure on margins. It's this tug of war between the good and the bad that lands us squarely at market perform.
So if you agree with that take, how might you play it? Now, just as an idea, one interesting approach could be a paired trade. You'd go long on NXP, but at the same time, you'd short a big semiconductor ETF, something like the SOXX. The whole idea is to bet on NXP's company-specific strengths, like an Automotive, while betting against the broader semiconductor sector, which might be a little overhyped. The trigger would be NXP's next earnings report, where they hopefully show they're outperforming their peers. Of course, there's always a risk. A huge market rally could lift all the stocks, or NXP itself could stumble. It's a trade for a very specific view.
And that's our deep dive on NXP's beaten drop quarter. And of course, we have to say it, this is for informational purposes only. This is not financial advice.